Welcome to Annuity Basics, Rates and Types. I'm Greg Durrett, and I'm a Future Secured Financial trying to help everybody sort through these otherwise confusing and goofy things. So what do you say we go ahead and we just dive right in right now? Thanks for listening. So what types of annuities are most common? Well, there's only a few types. One called a SPIA. It's called a single premium immediate annuity. Now, those are very unique. We're going to get into each one specifically, so just hold tight. There is also the fixed annuity, not to be confused with the fixed indexed annuity, and also the variable annuity. So let's get into the details on these. The SPIA, the single premium immediate annuity, the most basic and simple calculated thing you can get into. Now, what are the features? Well, of course, there is the predictable lifetime income. It has a high exclusion rate. Now, what does that mean? What that means is that the income that comes to you is excluded from as taxable income at very high rates. Sometimes we have seen these based on age, stage, all these different things. You've seen these things come in at 96, 97, 98%. Sometimes even a little bit tweaky higher, more than that. But that means that that amount of your income that you get from these is not counted as income for taxes. It's great for emergency planning. It can really do a lot to help you if you haven't done much planning up to the point when all of a sudden perhaps you're running into a nursing home. There are certain ones that are Medicaid friendly, Medicare friendly. We like to mess with these terms a little bit, but people get confused, so I like to throw them both out there. It's just if it's something that you need in a time of need, it could actually come through. There are a variety of terms. You can do a 5-year, 10-year, whatever. All of that stuff comes into play based upon your individual needs. Now, what are the cautions that are generally associated with this? Well, that means immediate annuitization. And what does that mean? That means that once you start it, and you can defer, you can go right away, or you can go up to a year of deferral. But once you do take the income, that annuitization kicks in, and that means that you will never ever again see that lump sum. Now, very low interest, very low. We don't like to see that low of an interest in most things we do, but again, if it's a planning issue that requires it, it's something that makes sense. Now, some of these will forfeit the remaining balance on death. You need to be very, very cautious about that, because if you're not cautioned about it, what's going to happen is your heirs are not going to receive whatever money you didn't spend while collecting income. So be very, very careful about how you approach these and make sure that the planning that you're doing for them fits the product. Annuities. Very, very stable, like a spine, most spines. What are the general features? Well, guaranteed interest. That's pretty good. They have low, they have minimum guarantees. They're typically low, but they have minimum guaranteed interest. And a lot of times they'll have some good upfront interest rates to try to get you in. Typically that's not going to keep going, but there are a wide variety of terms. So it's not a matter of, do you want to have a 3-year, a 5-year, 7? You can go in all kinds of directions, a number of years that you want to have these things be in their accumulation and deferral period. It is excellent as a short-term alternative to a CD. And because why? Annuities accumulate interest without having annual taxation. It's deferred. Whereas a CD, every year you earn, they're going to declare it as income and you're going to pay taxes on that. Whereas in an annuity, not only does it get deferred, but now your interest that you're earning is being earned on that higher deferred amount. So you're earning interest on your interest as well as your principal each and every year. It's a very, very nice thing. So that tax-deferred growth can come to your rescue when you want to accumulate faster. There are a wide variety of income options. We can't address them all here. You might want to look at some of our other videos and see what type of things are out there. But suffice it to say, you do have quite a number of ways you can get access to your money, as well as but put out the interest and the income that you're looking for, not necessarily as a withdrawal, but as an income stream for life. What are the cautions? Yeah, pretty low interest on these, but hey, you know, you're getting a guarantee. You're not going to get hurt. You're never going to lose money. It's impossible. The rate may not match term. What does that mean? That means that a lot of times there's an introductory rate of interest, and then whatever happens type of rate thereafter. So you need to be cautious about that sometimes the introductory rate might look really attractive, but then after year 1 or 2 or 3, that rate drops, and you're going to be a little bit surprised if you weren't expecting it. Contributions may be limited too. Sometimes it's only, hey, look at first year only, or only for the first 5 years, or the first 3 years, or whatever the case may be. So you want to make sure that if this is something that you are looking at for a long-term planning option, you want to make sure that it's something that will accept money. Somewhat inflexible insofar as the way that they function. They are company-declared interest rates typically, and so you don't get to pick what it is that you want to have your money in. It is a company-provided product, insurance companies. What about this fixed indexed annuity? Well, we talk an awful lot about that, and we actually have other videos that do address this in grand detail, but let's go through a general overview. Very high potential gains. Very high. Uncapped sometimes. Very high income options. That's a beautiful thing. You want to be able to max out your income when it comes time for retirement. A wide world of varieties in this index option. So it's the S&P, the Dow, the NASDAQ, the Barclays, Russell. Yeah, I mean, the options are seemingly endless based upon the company and the products that they have. You have increasing income options. So instead of locking yourself into a fixed income forever and not having any ability to adjust for what's going on with cost of living, these things have some of them have increasing income options. You have interest and income bonus options. Again, depending on the carrier, depending on the product, they will give you some variety of bonus that either is one time, it's deferred over a number of years, or it continues year after year. Very, very strong stuff. And the biggest thing is that when we talk about markets, these particular products have no risk of market loss. Your money is protected from the market going down. You will not have any market-associated losses with a down market. It's a beautiful thing. So what are the cautions? Sounds like I just painted Nirvana, right? Now, you got to beware of the older style two-tier annuities. And what a two-tier is one that says, okay, well, over here is your income and over here is your money. And they try to trap you into the discussion that, hey, well, maybe all you need is income. Well, maybe things are going to change for you someday in the future, and you don't want the income. Maybe you want the money. Well, a two-tier is going to deceive you as to how much money you actually have. We can get into details on that if you call us, because otherwise it just gets too deep in the weeds for a nice little YouTube presentation. All right. Some have low caps and high participation rates. Again, you want to know what those are in detail, go over to the Fixed Indexed Annuity Part 1 presentation, and we'll get into some of that for you. They have a lot of moving parts. This is a true thing. It's a good thing in most cases because of the fact that you get to tweak and twiddle and do whatever you got to do to get that thing to perform the way you want. But sometimes folks feel it's a little bit overwhelming. Well, then again, this is why we exist and why experts exist in this area. We can help you. You have to manage it every year. It's true. You got to take a look at it every single year and make sure that the performance is where it should be, or if you need to make some adjustments, or if it's time to start thinking about taking income. Variable annuities. Talk about the tightrope walk of the century. All right, what are the features? They purport to have the highest annual gains. Well, that's only because they say that they have nothing in the way between them and the market. All right, I'm going to go with that because that's what they say. Some have a death or an income bonus. That's usually as a hook to try to get you to keep the product. And that's about all I can say about features. Cautions. Super high cost. They have some of the highest cost basis in the industry. They are market based, so they are tied directly into securities and securities markets, which means what? Risk of loss. It's considered an investment, so you need to have a securities licensed broker to sell it. We do not get involved in these in any way, shape, or form. And because of this, your entire value is subject to market risk of loss. We don't work in that place. We don't work in that space. I say reasonable gains, strong gains, in a protected downside is a far better place to be, particularly when you're considering you're working with money earmarked for your retirement. Or that's Annuity Basics, rates and types. If you want to learn more or perhaps find out what might work best for you, please do give me a call and I'd be happy to talk with you directly. Thanks for listening.